Yeah, it's interesting. So, all right, we'll get started because this is a recording and anyone that hops on, that's great. Thanks for coming again, Rob. And thanks for being here, Ryan, again, and Arana Greenberg. So yeah, we'll get started. I am the expert mentor for today's session. This is the third one that I'm on. It's been on investing in real estate. And I'm Sean Casper. I'm the managing director for Coastal Investment Company. We are a private equity firm here in South Florida. And we invest in multifamily development projects, self-storage all over the country. And I have been in your shoes before. I was in real estate for 15 years and the residential side of it. I was an agent for 4 or 5 years to start. And then I went into the leadership side, opened brokerages across the state of Florida. We were eventually acquired by private equity and then acquired by Compass, which is how I sort of got to this position to be on Chirag Shah's coaching as an expert mentor. I was the regional vice president for Florida, for the whole Florida region. We had about 3,000 agents at the time. And that was before I went into the capital market side of the business, in the private equity side. So Chirag asked me to come on and educate some of our agents and Compass agents and bring value to investing in real estate. And the first one was pretty basic on, one of the benefits of investing in real estate. The second was about an investor questionnaire and how to get some of your clients to potentially think about investing in real estate if they're not already. For example, if they sold their home for $500,000 or $2 million and they took some money off the table, they may not be calling you as their agent asking you, where should I invest this money? Some of them would, but not all of them. They might be asking their financial advisor for that advice. So we were trying to sort of kind of alter the conversation of you being able to provide value to your customers and giving them tax strategies, right? 1031 options and different things like that from an investment standpoint to educate them. But today we're all going to talk about diversifying your portfolio. And that has to do with diversifying either your portfolio or your client's real estate portfolio. And that's there, a lot of them probably invest in the market already in stocks. This is about getting them to sort of diversify their current portfolio into real estate and different alternatives. And that could be the private sector, meaning them flipping homes, Airbnbs, long-term rentals, multifamily, things like that, as well as the public sector. So real estate investment trusts and things like that. Does anybody have any questions so far? Okay. Let's move on. Okay, so pretty basic. I'm sure many of you know what diversification is. I looked up the definition just because I wanted to see exactly what it said. I'm sure we all know if you were to be asked about it, it would be not putting all of your eggs in one basket would be the layman's terms of it. But the actual definition, which was interesting, is the act or practice of manufacturing a variety of products, investing in a variety of securities, assets, selling a variety of merchandise. That was an interesting part of it, selling a variety of merchandise, right? Let's say you have a store. You don't want to sell one product. You want to diversify what you're selling in case one product, goes out of business or go off the shelves. So that a failure in or an economic slump affecting one of these would not be disastrous. It's interesting of this timing because of what just happened recently with Silicon Valley Bank, Signature Bank, and then First Republic, right? They weren't very well diversified in their portfolios, and you get to see exactly what happens. And we really haven't seen that happen in the last 10 plus years, especially from a banking standpoint, right? Silicon Valley Bank was super heavy in VC and tech. And there's been so many headwinds in that sector over the last year plus. When they made a huge bet on low interest rates, and when there was a run on the bank, right, $40 billion was tried to take it out of the bank in one day. That can't happen, right? They don't have enough cash or liquidity to pay them back. And should they have diversified more, not just in VC and tech, they would have had a better opportunity. Then maybe they wouldn't have had that type of bank run. I did some research on Signature Bank about a month ago after everything happened with Signature, and this was shocking. And I guess it was shocking because you you wouldn't expect this to happen in the banking world based on what I think we've all learned, but then it's not surprising of what the other side of it is as well. And they were very, very heavy in real estate. They were very heavy in core and value add multifamily real estate, which can shift with interest rates. So when interest rates started to move, their auditors and their advisors said, you need to diversify. You need to start diversifying outside of real estate to have a better balanced portfolio. And they started investing in crypto companies, and cab drivers were two of their main investments. You think about Uber, you think about these other companies that are these huge disruptors. Now, you invest in crypto and cab drivers, you're going to generate some massive returns quickly. But what is the longevity there? And they just couldn't withstand that, and they ended up going under. And obviously very risky investments when you get in to crypto and cab drivers, and both SVB and Signature Bank were purchased. And then what ends up happening is the contagion, right? First Republic, nothing really happened with First Republic. The issue with First Republic is that they had the largest amount of uninsured customers, right? So the FDIC insures their customers up to $250,000. Well, First Republic has the largest amount of high net worth individuals that bank with them. And there was a huge run in the bank, $70 billion in one day. That was just from contagion from SVP and Signature. So just an example of what we're seeing firsthand from what happens when you don't diversify, especially from a banking standpoint, of what can happen. And as I go along, if anybody wants to stop me or ask some questions, feel free to just chime in. I know it's a small group here, so we can be as interactive as we want. Now, we talked about the benefits of investing in real estate and why to diversify. We've gone through these before, but all of you probably know, right? Cash flow, the income, the leverage, you get the debt, tax benefits, appreciation, and the inflation hedge. Those are the main benefits of investing. And there are really two different areas that you can invest in: the private sector, and then you have the public sector, right? The private sector would be the deals you all do, right? Buying a duplex or multifamily properties, or investing in Airbnbs and short-term rentals right now. Flips, that's all private, right? Some of the private equity deals as well, which is what we do on a little bit of a larger scale. Some multifamily development and things like that, where you're investing with syndications, that's private as well. Public real estate investments would be if you bought REITs, right? If you bought the B REIT, the Blackstone REIT, or you bought Starwood, or you bought Brixmor, right? All of those are REITs. They're publicly traded. They're in different sectors, right? Brixmor focuses on retail. Starwood, as many of us know, is hospitality, hotels. And then Blackstone is all over the place. They're diversified in many different sectors. And recently there was a report that came out that it provided data that demonstrated how the private equity sector, which would be what I do as well as you guys and gals, it outperformed the public sector. And that's not just in 2022, that's over a long period of time. And I started to look at some of these REITs, and just as an example, Starwood was down, it's been down 15% over the last 5 years in total, down 26% in the last year. And the thing with Starwood is they pay an 11% dividend yield. So that's why a lot of people buy it, right? So although the stock might not be doing as well as a stock like Blackstone, which over the last 5 years is up 170%, but they don't pay nearly a dividend as Starwood would. So I guess I'm trying to give you some of this information, because when you're just out there having conversations with your clients or what you're investing in, most people are invested in the stock market, but not many people are invested in real estate sector of the stock market or in real estate alternatives, which provides you so many benefits compared to just investing in other places. And that's the point of trying to educate everybody on why you should be doing this, how to educate your clients on it, and really starting to do some research on different sectors, private versus public, understanding some of these things, being able to have conversations with people about it, whether you're in a showing, whether you're at the dinner table, or wherever it may be that you're with customers. This is really important stuff to know aside from, the day-to-day that, like I said, I've been in your shoes of buying and selling and farming and doing social media and things like that, of understanding higher level from an investing standpoint. All right, let's get to this next one. Okay, so you understand pretty much, why to diversify. Now let's talk about how do you get your clients to talk to you about investing. We talked last month about an investor questionnaire you could send out, and many of the people that were on the call before, we had maybe 40 or 50 on that. A lot of them I sent the questionnaire to, and I've been communicating with them over the last month. But you could send a survey out, that questionnaire or something else that to get the word out on if they should invest, and if not, why aren't they? If they have, what are they investing into, for you to learn more about it. And if they're a major investor already, what is the plan now? Right? If they were investing heavily in office, what is their plan? That's not a good place to be unless you're in Miami or a couple other places like Charlotte or maybe Nashville right now, some different areas of the Sun Belt. I was speaking to a developer a couple months ago, and he was saying he had been in office for 10 years, very successful, and they were moving into the multifamily sector. So it's important to know about the different sectors, where you want to be from a long-term standpoint, how you can diversify into different sectors. And I included this chart here, which shows what is the average portfolio value from an investment standpoint between the different sectors that make up a real estate portfolio. So you have residential, which would be anything that is under 4 units, right? Whether it's a single family home, townhome, condo, 2 units, 3 units, anything over 4 is commercial. And you have office, which represents 7.7%, retail at 23, industrial at 9.7, accommodation, which would be hotels and hospitality at 11, and multifamily at residential 28.5. That's where that would be, because that's considered residential. So those are different sectors, and for everybody to understand what is the typical portfolio value of and what's out there, right? We all probably knew residential would be the heaviest, then probably retail, and you could just sort of let this resonate as you drive around and as you see what's out there. Office, which is going down now, industrial, which there is a lack of supply, and you can see only 9.7%, which is why there's been a lot of development and success within that industry, accommodation, and then others there. Now, within each of these sectors, which this is something majority of people don't know, especially agents, when I'm out and I'm asking these questions, which hopefully will help when making investment decisions and speaking to your clients about investing in real estate. So you have 3 different types within each sector. So you have core, value add, and opportunistic. Does anybody know what the difference is between the 3? Or want to take a stab at it, of the 3 people here? All right, I will go on and explain. So core is something extremely stable, right? So let's say you're buying an apartment complex, the rents have gone up a couple percent, with inflation over time. The building is in pretty good condition. There's not much that you can raise the rent. It's just a very, very stable investment would be core. You're going to have the lowest returns when it comes to core investments, but they're going to be the most stable for the long run, and they're usually long-term investments. And that's within each sector. Then you have value add. Value add would be, let's say you're going to buy an apartment complex, you're going to fix up each unit, you're going to raise the rents, you're adding value to it. If you were going to do a flip, let's just say a single family, flip in Charlotte, and you bought a house for $1 million, you put in 200,000 and you want to sell it for $1.8 million, you're adding value to it. So you're manufacturing value to it. Opportunistic would be where there's the highest yields and returns, would be development deals, right? So building a house, building an apartment complex, building an industrial building, self-storage, any of those. So opportunistic would be highest returns, which also can come with more risk, which is why you need to make sure if you're ever doing that you're underwriting it properly, you're working with the right partners, you have the right contractors or developers or a board to advise on all of that. So those are the differences within portfolios, and then what is the difference of risk and returns from within each sector. So hopefully that helps guide you a little bit from that standpoint. So what we do is here at Coastal, the company that I'm the managing director and a partner in, is we specialize in the private equity sector. So multifamily development, which would be opportunistic in residential, right? As we just talked about, that's what we specialize in. We also did some value add, but not much now, just based on where interest rates are and yields, and then self-storage development as well. So in 2022, we raised over $100 million in equity. And what we do is we are sort of a hybrid private equity firm, family office, where we raise capital from high net worth individuals, agents, customers, and then we partner with developers all over the country, primarily in the Southeast, to develop institutional real estate. Our target IRRs are anywhere from 15 to 35%. Like I said, multi-billion-dollar developer partners. There's monthly distributions and capital appreciation on the backside, complete visibility into your portfolio, and then access to our board of directors for advice when it comes to, like we're talking about, diversifying into real estate or diversifying other investments, talking about different real estate markets, tax strategies, certified financial planners, whatever it may be. From a real estate standpoint. So let's say you had a customer that owned a portfolio of 20 apartments, 20 apartment buildings, let's say. They sold the portfolio. They don't want to manage it anymore. They don't want to buy something and be an owner operator, although they want to get back into real estate, but be more passive. That's where our group would come in, right? We would show them different opportunities for them to invest, which many of you probably have clients like that, that are out there. And so how can we help you? As I mentioned, we offer private equity investment opportunities from a real estate standpoint. We can educate and guide all of you on tax strategies for your clients when investing in real estate, whether residential or commercial, from a 1031 exchange and opportunity zone standpoint. We also have some other strategies within there from a tax savings standpoint. Financial advisory services. We have CFPs that are on our board. So again, let's say one of your clients sells their business and they're coming to you, they want to buy a house or they want to invest in real estate. We have an entire board that can help you navigate them along the way. As I mentioned, high-level taxation strategies, and then value add to your prospective clients. Let's say you meet a client, they may be interested in investing in real estate. They just bought a house or sold a house recently, and they're not going to transact on their primary or a second home, but they're interested in investing. You could set them up with us or have a conversation with us, and we could bring a ton of value to them with their situation on potentially investing passively, providing them some different tax strategies, talking to them about their stock portfolio, not me personally, but people that are on our board, and giving them this advice where it puts you out there as this obviously real estate connected consultant that can help them and guide them through different investments. And eventually when they go to sell, buy, or invest or rent, you're going to be the agent that they're going to want to work with or refer you somebody. So that's a little bit of suggestions on how you could diversify your own portfolios or your customers' portfolios, the differences in the real estate sectors, and especially outlining the difference between core, opportunistic, and value add, which is really important to know, and what risks come with them and what's within each one of those options. So I think we're at about 1:22. I wanted to leave some time for Q&A. We don't have a huge group here, so if anybody wants to ask any questions or talk about things, feel free if you want to raise your hand or just jump in.
I have a question.
Shoot.
I met a gentleman that is selling an apartment building in California, and he wants to reinvest 1031 exchange the proceeds into another property. He was looking primarily in Texas. And and he has always been an individual owner. So I'd like to introduce him to you and see if it might be a good fit. He's retired. He's probably close to 70. So he wants to keep going, but not be hands-on, I think.
Yeah, that sounds like a great client of ours. And I'll give you an example. It's a story that this just happened. There's an agent actually with Compass who lives in San Francisco. They're selling a building for 1.2. They have a 1031 exchange. And they are going to go with another tax strategy that we've put in front of them that most people's accountants aren't aware of, that is sort of a private equity tax strategy where you get accelerated depreciation on your investment, where then you can invest what's left over into a specific real estate investment. While with the 1031 exchange, to do a like exchange and not pay the tax, you have to invest all of the proceeds,
Right.
all of it. So what ends up happening is somebody says, well, I don't want to invest all of it. I want to take some money off the table. Well, anything you take off the table, you have to pay the tax on. So there are other strategies that we talk to our clients about that they could do, or maybe if they're, going to make $1 million, they invest 200 into this specific tax strategy, and then they're left with 800 in the gain. They pay the taxes that they have to on the gain because there's an investment opportunity that's going to make them more than going into a 1031 exchange option. Right now, there's not a lot of 1031s out there that are going to give you a high yield more than 4, 3, 4, 5%. So that's where we're stuck in this economy right now. But what we would do, Rob, is I would get Matt Chansey, who is one of our advisors. He's our tax strategist. He's got a book deal with Forbes. It's coming out at the end of the year for tax strategies. He's the perfect person that we would talk to. And then me, you, the client, and Matt would get on a call and go from there. So if you just want to make an intro via email, we can set that up.
Okay, cool.
Matt, who's a licensed CFP as well, we'll talk to him about 1031 options, opportunity zone options, the C-store option, that's what it's called, this other tax strategy that we have, and see what's best for the client based on, do they want income, do they want growth, do they want capital appreciation, and guide them in that direction. So that'd be Larry. I see a question. Is there a minimum required to take on a new client? It's $100,000 at the minimum to invest into one of our funds. Usually we'll find out what does somebody want to deploy in the next 6 months, and then we will help them diversify it into different options to give them a balanced portfolio between typically multifamily, self-storage, and BFR, build for rent, which is a new asset class that has a lot of steam behind it right now that we're working through. So hopefully that answers that question. All right, Arana or Ryan, any questions for now?
Sean, definitely want to reconnect for me personally. And then I do have a couple other clients, and I don't, off the top over the call here, have exact dollar amounts for you as far as potential here. And some of them may be in at different scales, but I definitely think some opportunities to network for me personally, my family, as well as, like I said, a couple other clients I'm working with. And oddly enough, we just sold their multi-million-dollar house here because he's owner and CEO of a major company, and actually I think we talked about this before, he's in Orlando, owns the 10th largest roofing company in the country, and is relocating to Florida just because that's where 90% of his business is. So I see a great opportunity there, maybe if he's open, because I know he's network major in the race world and so forth with about 8 different circuits and stuff. So light bulb just went off with him. But anyhow, yeah, definitely we need to follow up with each other.
Yeah, and that's great. We're headquartered out of Winter Park, Florida, which is in Orlando. It's a suburb of Orlando. So he could come by the office and meet the team, and we have 4 projects in Orlando, 3 multifamily and 1 self-storage, where we do a lot of site tours for new clients. So yeah, let's definitely connect and have a conversation on that. And again, everyone, for this call, this is really, the point of this is to educate everyone on really diversification and what other options are out there. I appreciate and any business that comes to us from this is wonderful. But I want to bring as much value as possible to the agents and to everybody that's on Chirag's playbook, because that's what this is about. So yeah, I'll connect with each of you after this, and I think there's definitely some options for us to work with some of your customers and really bring value to you so that you look better to your clients and your network. That has a lot to do with this too. So I appreciate everybody being here, and thank you for your time, and we will connect soon, and definitely try to be back next month. We're doing the next talk is going to be specifically on tax strategies for real estate. Matt Chansey, who I mentioned, is on our board, who is writing a book right now for Forbes on tax strategies in real estate. It's going to be an amazing series, and I'm going to have him as a guest. So I would definitely join back. It'll be on the calendar. I don't have the exact date, but I'm sure you'll get an email about it. So thank you again, and everybody have a great day, and we'll talk soon. So thanks for being here.